All right, Bulls and Bears, back with another dose. Economic reality. Let's go ahead and get right into it. BX4, bull to the bust. First of all, I apologize if the audio sounds bad today. I actually got another new mic. What kind is this one? The Blue Yeti mic. I think someone in comments recommended this mic. I think I tried this a long time ago, but I think it had some sort of bug in it. I kept hearing popping noises, so hopefully I've got it set up right. But give me a couple episodes to get it all lined up, for better audio. And we'll see how it goes. Anyways, let's go ahead and get right into it, folks. The financial, economic news, the powers that be, the bankers, the top 1%, at the top of the pyramid, they continue to try to convince everybody that what we're seeing in this economy is normal, that this is good. And for the people that don't believe that it's good because they see their own financial situation, they see the debt, they know the struggle, they know they can't afford a car repair without putting it on a credit card. Most people anyways. For those people, they're trying to convince everybody, oh, things are getting better. And what have we been hearing? We've been hearing inflation is cooling. Inflation is cooling. When really, it doesn't mean things are getting better. It just means things are getting worse, but just at a slower pace, getting worse at a slower pace than before, right? Most of you know how this works. Inflation still going up, cost of living still going up, but not as fast as it was previously. We've got the markets out there now. Dow Jones, basically 41,000 today. All-time high after new all-time high is what's happening here. And we haven't had the official announcement of a rate cut yet. But there's a lot of people, a lot of investors in the markets are listening out for the Friday speech from Fed Chair Jerome Powell. Will he indicate rate cuts? If we do, you could see the market skyrocket, folks. This is all manipulated at the click of a button. The top 10% buying up the stocks. They own about 90% of all stocks. Does a stock market at all-time high mean the economy is good? No, of course not. If that was the case, we wouldn't see record levels of debt amongst the U.S. consumer. It just doesn't, add up to a good economy. So it depends on what you mean by economy. If you're talking about most people, no, the economy's not good. Again, people buried in debt. We're going to look at a debt chart here in just a few minutes, but the anxiety is starting to creep in to the U.S. consumer. They see the layoffs, and a lot of people are seeing a slowdown at their own company. So therefore, we're seeing news like this. Americans think they'll be out of work and are looking for jobs at the highest rate in 10 years, folks, the highest rate in 10 years. So where is the consumer confidence? We were told that, a couple months ago, consumer confidence ticked up. And we were like, okay, why are people confident? Are they confident that a rate cut's going to come in and help their situation? So highest in 10 years, more Americans are looking for jobs, and unemployment worries are at their highest level in a decade, according to a new survey released by the Fed of New York on Monday. According to the Fed, average expected likelihood of becoming unemployed in the next 4 months reached 4.4% in July, the highest level in 10 years. So more people out there worried and concerned about their job, especially with these debt levels. Now, losing a job, it's bad enough. But when you're loaded up on record levels of debt and then you lose your job, folks, that's a very short amount of time and you're going to be wiped out without a couple paychecks. Remember, just 1 or 2 paychecks in 2020 when everything got shut down, 1 or 2 missed paychecks. We even had federal workers out there begging for money on apps. And what was that app? Not sure if it's an app, but it's a way to GoFundMe. It's a way to save or to raise money. And we had federal employees just 2 weeks after the shutdown begging for money. So we know that even higher paid people like these employees, government employees, 1 or 2 missed paychecks, and they have so much debt, the cost of living is so high for them, even they're in big trouble. Another article here that backs this up here, more than 28% of Americans are now searching for a job, the highest rate in a decade. So more than 1 in 4 people looking for a job. People's fears of losing their job are at the highest point in 10 years, just like we talked about in the previous article. But 1 in 4 people now looking for a job. So what does that tell you? Could it be a lot of realtors since they updated the way that commissions are handled in real estate? Pretty interesting. We'll have to go ahead and keep an eye on that for you. So why don't we take a step or two back and just think about this. Think about what's being put out there. Think about what we're being told. We're told the economy's good. The consumer is strong. The consumer is resilient. Yet 1 in 4 people looking for a new job because they're worried about losing their current job. And let's just go back to the rate cuts here. Why are we talking about rate cuts? If everybody's good and fine, if the debt levels are sustainable and can be handled by the masses, why do we have to talk about rate cuts? It doesn't make any sense, especially since we're not at the 2% average inflation target. Remember, to get the 2% average target, we have to have several years of deflation, meaning negative growth or falling prices. We need a big correction in order to have an average of 2% if you look back over the past 4 to 6 years. But of course, they're not going to allow that because that would break up the whole facade of a good economy. The Fed confronts up to 1 million U.S. jobs vanishing in a revision. Folks, we talked about this here many times, how every month this jobs number comes out. It's usually bad when you have 4 times as many people losing their job versus the new jobs added. But then it's even worse if you wait a month and then look back, it gets revised. But then by the time the next month is here, people are looking at that month's number and they forget all about the previous month, right? Nobody hardly ever talks about the revised number because it's gone, in the past. But everybody takes it at face value. I shouldn't say everybody, not my viewers. But markets, and we're told investors are taking these jobs numbers at face value, and we see the market shoot up when we have a good jobs number, only to have the number revised the following month. So then if the markets are shooting up because of the current month job numbers, why isn't the market selling off the following month once it's revised? So again, it's another piece of the puzzle here that doesn't add up. So we know that these markets are just manipulated. They're using phony news, phony figures, false data in order to justify the rise in the stock market. And again, it's mostly the top 10% buying up all the stocks here. Move on a little bit here. We've got investors counting down to the Friday speech. What will Jerome Powell say? Will he come out and say we're definitely going to cut rates? No, I think it's going to be more vague than that. So then you're going to have people hanging on his every word. What did he mean by this? What did he mean by that? Is this how an economy should operate? Is this how people should decide if they're going to invest? By listening to somebody give a speech and reading off of a script and then trying to figure out what he means and trying to put his words together and trying to piece together what might happen? What kind of economy, what kind of financial system is this? It's just, to me, it's completely bonkers. Moving on here to real estate and the housing market / housing bubble. The median home price in San Diego dropped $30,000 in just 1 month. Remember in our previous report, we looked at the Fed median home price, and it was a lot different than the Zillow and that the realtors put out, and different than Redfin put out. It was actually showing much more of a peaking pattern, and we'll have to continue to keep an eye on that. But here's another piece of the pie here, piece of the puzzle. Median home prices are still up 5.3% year over year, but a $30,000 median home price drop in 1 month is very significant. I've been saying here for over a year that I think October, which is less than 2 months away, will be the month where everything falls apart. Now, I'm kind of going out on a limb by saying that, but if you look back at history, October is a big month for crashes, sell-offs. A lot of big things happen in November, or October rather. So I'm going out on a limb. Please give me a thumbs up if you appreciate my timeline, right? Some people just say correction's going to happen someday. We don't know when. I'm actually putting my you-know-what on the line, saying something big is going to happen in October or sooner, right? So if I'm wrong, I'll own it. And I'll be here and I'll watch some of you make fun of me down in the comments. It'll be okay. Maybe it'll be fun. But if it happens, I think a lot of you are going to be probably maybe not so surprised. But I think it's going to be an impressive thing. We'll have to see how it plays out. Average American household debt in 2024. Sometimes charts paint a picture, or a picture tells 1,000 words. Look at this. Here's 2008, 2007, 2008 financial crisis. Look at the debt levels. Now look at today. Fast forward. Look at this. We are at, as of the most recent month, second quarter, end of June here this year. Look at this. How much higher it is versus the housing bubble years. And we're told everything's fine. This is normal. So if it was bad, if debt was bad back then, if debt was too high back then, if home prices were too high back then, and everything's worse now, the debt levels are higher, home prices way above where they were back then, home housing unaffordability much worse than what it was back then. Isn't it interesting how things change, right? Over 10 years ago now, but things change, right? Used to be that was bad, debt was bad. Now debt is good, and the consumer is strong because they have the ability to borrow more. That's what we're being told. Insane, folks. Let's move on to car prices. Car prices are down year over year. They actually ticked up in the first half of August. Manheim Used Vehicle Index. This gives us the prices at auctions. And remember, dealers are not, for the most part, not yet passing along the savings to consumers. So we'll have to see how this plays out. But vehicle prices ticked up 0.5%. That's a half of a percent. But looking year over year, we see some price corrections in action here. Let's bring this up here. See if I can enlarge this. What do we see here? We see, mid-sized cars down 4.3%. Pickups down 5.6%. SUVs down 5%. So you can see all across the board, vehicle prices are down. Leading the way, though, electric vehicles, as we talked about here, they're going to continue to lead the decline in values. EVs, electric vehicles, down 7.2% year over year. That leads the charge. So good news to some, bad news to others. But if you're looking to buy a car, that's some good news. Maybe some relief amongst this cost of living nightmare that many are feeling right now. Folks, now, in every few videos, I think it's important to always go back and just remind everyone, because there's still a lot of confusion out there and people wondering, scratching their heads, wondering how this is possible. These price bubbles staying elevated. Well, we know the manipulation, the rescue programs, but it all goes back to the sound or the system of money. We no longer have sound money. In early 70s, 1971, we came off the gold standard, meaning endless amounts of dollars could be created. And it used to be they had to be printed in those dollar bills and coins, right? They had to be coined or printed. Now it's just digits on a screen. Literally, you can click the mouse or the button as many times as you want and create trillions of dollars. So this is why you see things like $1 million gold bars. That's actually a real news story. $1 million gold bars, because of the price per ounce now, about $2,500. The price of gold set a new all-time high. We all know that, over $2,500. A gold bar, the average gold bar weighing 400 ounces, now has a value of over $1 million, folks. So this should be the warning sign, but we've known this for years. We've known that central banks around the world have been accumulating hard assets, gold, silver, other precious metals. Why? Why are they not just hoarding crates or barrels or bins full of dollars? Why are they hoarding metal? Because the banks know that the days are numbered for all fiat currencies. All fiat currencies ultimately go back to their value, which is zero. Folks, it's just paper, and it's even worse than just paper. It's digits on a screen that can be erased. They can be taken away from you at the click of a mouse. Look at all the hacks and the system outages that we've seen, the data breaches where everyone's, from what I read, billions of people's social security numbers got stolen. So now security experts are out there now urging everyone to put a freeze on their credit reports, because your number is probably out there somewhere, maybe with a few people, maybe with hundreds of people. Maybe it's being sold on the dark web. We don't know, folks. But this is the money as well. The money is just digits on a screen. So how do we know they're not just funneling endless amounts of money into the banks? And we already know that the banks, your local bank, Bank of America, even your credit union, they're loaning out money that they don't have because they're loaning it out in digital form. It used to be they had to have the money in the vaults to loan it out, right? Because it was physical. Several decades ago, we went to just digital currency. Now the banks can loan out endless amounts of money. I know this sounds crazy, and some people may not even believe it. I have new viewers sometimes asking me questions. Oh, this is not fact. You can't prove this. Folks, just type in zero reserve requirement Type it in. Do you know how to use the search engine? Type it in a search engine. Zero reserve requirement. And you'll see, this is not just me saying that. This was something that was passed in 2020 to allow banks to keep loaning out money because they knew, well, first, they were afraid of bank runs. They were afraid of panic, and they wanted to stimulate economic growth. So that's the reason why they first dropped the reserve requirement to zero in 2020, the health crisis, etc. But after that, remember, we had the bank runs, we had the bank panic, and some banks failed in 2023, which really weren't bank failures because they just got bought up by larger banks. So then they kept it in place, and it's still in place as of today. Why? Why would that be? If everything's fine, if there's nothing to be concerned about, if this is just doom and gloom, if this is just fear-mongering, why do we have a zero reserve requirement that was implemented as an emergency measure back in 2020? Why do we still have that in place right now? Just answer me that one simple question, and I'll be glad to hopefully respond to anyone that gets the answer. The answer is because we're in an economic crisis, but hardly anyone knows about it. It's being masked. It's being covered up. But we know what's going on with inflation. The result of all these bubbles being propped up endlessly is inflation that will not go away. It may slow down, and you may see a month where it dips from the previous month. But until something big changes, I doubt we're ever going to see a year-over-year decline or deflation year over year. Again, you might see it from week to week or month to month. Prices fall a little bit here, a little bit there. In different areas, like car prices are falling. But overall, inflation is going to keep going unless somebody pulls the plug on this money creation, meaning they have to change the laws. And we're told that the BRICS nations are out there going to a asset-backed currency, commodity-backed, asset-backed, precious metals-backed. We're told that. Is it true? Well, we'll have to wait and see, but I wouldn't be shocked. I wouldn't be shocked if we have a night of the shift where all those countries, over 150 now, dump the U.S. dollar all at once. Interest rates would spike, markets would collapse, and then you have to ask yourself, is the Fed big and powerful enough to come in and buy up all the dollars that are being dumped to bring interest rates back down? Remember, that's what they're doing now. They're keeping mortgage rates suppressed, even though they're higher than they were. They're keeping mortgage rates suppressed with all the purchases of the debt, folks. So can the Fed keep all this going forever? History says no. We don't know how long we have, but prepare, because I see something big right around the corner. We're talking just a couple more months here. I'm talking about likely before the end of October. That's just my opinion. What's your timeline on this? Are you stacking? I hope you are, everybody. As always, keep stacking. Thanks for being here. Make sure you subscribe. Very important time to keep on top of the financial, economic news. We'll see you in the next report. Big love. Bye for now. Peace.